Hello there.
Hey.
Hello and welcome back. Sorry for the delay. We were going to do it yesterday, but things happened and we could not. But we're here now. Um, and we're going to be talking about some stuff that we don't normally talk that much about, actually. And I'm not going to lie, I'm kind of excited because this is not a topic that I'm usually like that into, but it's very important. Right?
Right.
So let's get into it. And by the way, Rob, hi. It's good to see you.
Hi.
It's
Always.
good that your internet's working and
It's
all that.
working better than it was yesterday so far, so that's good.
It's perfect. All right, so let's see. Today we're talking about portfolio structuring and kind of investor personalities, because it's fairly important to understand who you are as an investor, what type of personality traits you have, in order to be not only a better investor but also building the portfolio that best suits you, right? And we've borrowed some information from another creator, and I'm going to give him credit, obviously. So we've borrowed some stuff from Invest Answers because they created a let's call it an investor profiling matrix, and also looked into how many of the top 100 investors, like how many of the top 100 investors are, how they fare in the like personality traits and all these things, so that you can see like, okay, so they have all these traits, and maybe if you look at this and you see, okay, maybe I am a feeler, for example, but a lot of the most effective and most successful investors in the world are mainly thinkers in comparison to the feelers. So maybe then when you realize that you have that weakness, so to speak, you can work on that and kind of improve to kind of move over to the more thinker side, for example. So this is kind of something that we're gonna be talking about. There are some questions already in the chat. I see, Rob, you got a question. You have a fan.
Oh, yeah. He knows far too much about the inside of my room, it seems.
Yeah. But hey, renovations, right?
Oh, yeah. Needed to be done.
Precisely.
No.
But yes.
Yeah.
No, yes. No. Maybe. All right, so I'm going to start off with saying that I'm going to actually open up this here. So I've written down this from basically exactly the way that they created their profiling on Invest Answers and their, and the numbers that they got out of it. So this side here, as far as I understand it, they looked at the top 100 most successful investors in the world in history, and they kind of looked at what type of personality traits they have. And obviously, extrovert is like the opposite of introvert. Sensors are opposite of intuitives. Thinkers opposite of feelers, and so forth. So the first thing I want to talk about is this part here. For me, I know that, I mean, you can see 43% are extroverts and 57% are introverts. I know personally that I am an extrovert, for example. I don't know about you, Rob, but I'm pretty sure you're
INTP. That's me.
INTP. Yeah, these are not exactly the same as the classic personality trait thing. This is more like
Well, those they still show up there. They're the same ones. So
yeah. Yes. So I guess if you know that you're an extrovert, I mean the difference between an extrovert and an introvert is not really that big. It's a 7% difference, right? In what is going to give you more success according to numbers, at least. So maybe that is not one of the more important parts. But jumping down to intuitives versus sensors, for example, if you know that you're a sensor, if you're a realistic person who likes to focus on facts and so forth, then maybe you should try to kind of work on becoming more intuitive. If you want, you don't have to, but obviously,
I'd say so. So the things that I always, I always find the sort of Myers-Briggs thing a little bit woolly, in that everybody can be placed into one of these boxes. And say the way I kind of came across and approached the application of it is that you don't necessarily sit entirely in one of these sort of 16 boxes, but you say you can borrow particular traits that put you into sort of one box more than another. And it's more a, I don't see any particular reason why an S is less likely to be a successful investor than an N. But obviously, there are particular features that may guide you towards having particular traits, but that doesn't mean that you can't succeed without those traits.
No, precisely.
As Golden Goose says there, a lot of these objections are very subjective, like a horoscope.
Yep.
To an extent, yeah. I think there's some correlations though, which do make it quite clear that certain types are more suited to being an investor than others, and similarly, some people just maybe naturally don't have that same aptitude or that same mentality that gears them towards it, but that doesn't mean they're not capable of it.
No, for sure not. I mean, again, this is just the research that has been done on the top 100 most successful people, right? And these are the traits that they have. It doesn't mean that if you don't have, if you're let's say an extrovert sensor with a lot of feelings, I guess, and a perceiver, then it doesn't mean that you can't be successful, right? That's not what it's about. But it's about understanding, like, if take an example, the whole FOMO thing. When people FOMO into something, that's when the feelings start working you, right? And looking at the feelers here, there's 0% of the most successful are feelers. I suppose that kind of, I don't want to say proves the point, but it makes the point that try to stay away from you want to keep your emotions out of your investing, right? That's what most people tend to say. When emotions starts bugging you, it gets really difficult, like mentally. And I think that the feelers and thinkers thing here kind of strengthens that argument for me, to a degree at least. So it's this thing is more of a fun thing to realize that, okay, maybe you are a feeler, but how can you then work on getting to become a better thinker in comparison? Maybe that will help you a little bit. I mean, just getting rid of, like, having a plan, for example. You know what I mean? Like, you have a strategy that you're just going to execute. You don't think about your feelings when you're investing and all these things. That will probably help you get away from the feeler type side where you can feel that FOMO and everything, right? If you have your strategy, you just play that strategy, and then the emotions are kind of removed from the whole situation, right? So that's one of those things. So this is why I wanted to start with this, because this is just like maybe not the most important part of it, but it gives you at least a thought. Whoever is viewing this right now, like Golden Goose and Imre, I know you're both here, but if you're looking at this and you recognize yourself in one of these, then at least you know who you kind of are as a person, right? And then looking over to the investor profiling here, if you can sort out what type of person you are in terms of investing. For example, myself, I'm long-term, quantitative, narrow, and risk averse, right? That doesn't say much, but at least it gives you an understanding of, okay, this is what I like to do. I like to think long-term. I like to do my math. I like to focus on not many things. Like, for me, I have like 4 things in my portfolio, 5 things in my portfolio, and that's it. if I'm like, I know Rob, you have a lot more different plays that you play, so you're more of a broad focus in that sense. But
See,
still, it's mostly crypto, right?
we've had this discussion. Say,
Yeah,
my argument is no, I'm not. I say I'm incredibly narrow focus. However, I just have a different method of looking at it than you, in that
yeah,
I am I am more interested in the fact that this is a statistically gaining space that should, if you make the right choices, outpace the overall market in terms of growth, in terms of adoption, in terms of capital appreciation of things that you invest in. However, I accept that there's an awful lot of uncertainty because this is a high risk asset class. Even
yeah,
the safest part of it, if even Bitcoin has a certain level of risk, whether it's perceived risk or risk that's worth taking. You say there's risk doesn't mean it's not worth taking and it won't pay off. It's simply a measurement of the fact that there's a certain level of down expected to this asset as well as a certain level of up expected. And so I've always been, I will invest in multiple in multiple assets, in multiple coins, say multiple altcoins, multiple plays, multiple layer ones, on the basis that I don't necessarily know I've got the right answer. And
yeah,
you can have the best project in the world that goes nowhere if it doesn't have the adoption. You can have something that is absolute substandard that makes huge multiples because it had good marketing, good product, good a good execution of the project. So I simply like to apply my own strategy, which fundamentally will get me out automatically without me having to say, press the sell button. So my wide range, my broad approach is in terms of applying one strategy to multiple coins within a market which I expect to move up together. So I'm not really investing. I'm simply allocating a portion of my pot into a space to trade according to
yeah.
my strategy basis.
Right. Yeah. Yeah.
But
Exactly.
it's still, so to me, it's still a narrow focus, but to you, it's a relatively broad focus
Yeah.
because I look at a lot more than you.
Right. Yeah. I think the way that when these numbers came down or in, what they said was their let's call it their thinking around broad focus versus narrow focus was narrow focus means few assets so that you can, like, for example, if I told you to tell me everything you know about every coin that you're invested in or token, you probably know a fair amount about it, but keeping tabs on everything that's going on in, let's say, a pool of 30 different coins is very difficult. There's a lot of things happening, a lot of news with everything, this is updating, this is doing that, this whale is selling this. Like, that's where the broad comes in, because there's a lot of things to keep track of. If you have 3 or 5, it's manageable. So that's what they mean, but the narrow focus /
But if you accept that none of that really matters because they're all going to go up together.
yeah, precisely. But this is also the thing. I think you're more risk taking than I am in that sense as well, because you're taking the risk with a lot of different plays, but you do it because you want to hedge them against each other, because some will go up a lot and some will go down a lot.
Essentially, I'm trying
to
take
way of hedging.
I'm trying to take a statistically sizable chunk out of the market by making educated guesses on plays that I think might exceed the market on the whole, and also how to lower my. I'm looking at protecting myself by if the market gets out and turns to shit, I will sell all of my positions automatically. Now, I'm relying on the ones with the best technicals to provide the best returns over a period of time. And then when everything rolls over and it all rolls over together, it doesn't matter what coin that you have, 97% down feels a lot like 98% down.
Yeah, precisely. So, I would even say that 98% downs feel very similar to 90% down, because when you have a sizable bag like that and things start going down, it's and even a smaller bag, like when things go down, they go down. And this is one of the reasons why we also do most of our TA on Bitcoin, for example, because what that does, everything else tends to do.
Especially this phase of the cycle and this phase
Yeah.
of investment. Yeah.
For sure. But either way, so the point of this investor profiling is that if you can look at this as an investor and say, okay, I like to think short term. I want to buy something and I want to hold it for, let's say, I want to sell it next week, or I want to sell it in 1 month or whatever. Then you would probably end up being more of a short term player. That kind of you're more of a trader than an investor at that point. But for someone like me, who is more of a, I accumulate for like half a cycle, which is, let's call it a 4-year cycle. I want to accumulate for 2 years, and then I want to wait for 1 year, and then I want to sell for 1 year. So
It all sounds so
that's more
perfect,
long.
so
Yeah,
easy, right?
but that's the thinking that I have. It's that sounds ridiculously easy. It is tremendously difficult. but yeah, so that's the difference there, right? Intuitive versus quantitative is more like a quantitative person would probably do a lot of research, a lot of mathematical looking at data and statistics and stuff. And that's something that both you and I do, Rob. I know that. We like to know what the hell we're getting into, basically, at least to a degree where we feel comfortable. While a lot of intuitive people would say, oh, that started an uptrend. What is it? I don't know. Click, buy a bunch, and then you wait and you sell, right? That's more of you just go for it, right? And that kind of plays together with a risk-taking kind of person as well, I think. But yes, so I don't even know why this is still here. Kind of just realized that I
Just do some live live.
I was supposed to.
Editing. There we go.
Yes, I was supposed to do something like this and move
It really
it.
doesn't matter at this point.
That just looks nicer.
Yeah.
Either way, so this is something I look at a lot. If you're watching now, you can just take a screenshot of this and just. And I also recommend watching Invest Answers video on this. It's like a whole series, I think, and I really like them a lot. They do a lot of good research, and at least there's a lot of numbers behind everything they say. So I like to watch them, and then I do my own research on top of that, of course, just to make sure that I'm comfortable. But yeah, so this once you figure out how you kind of work as an investor, then it's much easier at this point to start looking at what type of portfolio structure would be good for you. Mine is very simple. I don't know exactly. Actually, Rob, I'm not really sure exactly how your portfolio is structured. More than it's all very liquid, isn't it?
Yeah. So typically, I don't refer to myself or call myself much of a hodler. I'm whenever I have an entry, I always have an intention to take some profit at some point. Now, Bitcoin is my sort of primary savings mechanism. So long term, the intention is that my savings go into Bitcoin, and from there, the decision is, what do I want to allocate a section of my Bitcoin in that I expect to beat Bitcoin. So, for example, what percentage do I want to allocate towards Ethereum? And that's a percentage that I would look to then intermittently rebalance. If my my cash is, if the cash section has performed particularly well, as in the cash section, that I would allocate in and out of altcoins according to my strategy, then that's essentially a trading pot. That's not an investment pot that is designed to sit there. However, it is a pot that's designed to sit in a market, in the crypto market for a long and extended period of time, where it will take entrances and exits as it sees fit. So it's still an allocation to the space, and then having the certain allocation towards Bitcoin, a certain allocation towards altcoins, and then having a certain allocation just of literal cash that is sat there to one side, and those are roughly split into about 4 pots of approximately equal weighting, where it's just Bitcoin. Then I have an altcoin holding pot. Then I have a trading pot, which is cash to go in and out of, and then I have cash for a rainy day. And that allocation may move backwards and forwards constantly, depending on the time of day. Because if things go well, then yeah, I'll look to rebalance those sections. If Ethereum's had a particularly great month, I'll sell some Ethereum and use it to buy some Bitcoin with, and just sort of keep those pots just sort of slow, intermittently rebalanced.
Definitely. I mean, it's a very good thing with, if you do a lot of swing trading, for example, looking between, and with that, I mean, if you're looking at, let's say, instead of just looking at, let's call it Ethereum and a Bitcoin and Solana and Polygon or whatever against the dollar, right? If you should probably also look at how all these different ones are doing against Bitcoin, right? So you use Bitcoin as the denominator, right? And doing that gives you, it's a very nice thing to, because if you're like me, I want to accumulate BTC at the end of the day, right? I don't want to accumulate more stable coins. I want to accumulate more Bitcoin, because for me, that's a better form of money, right? So when I look at things, I tend to look at everything against the dollar, and then I tend to look at things against Bitcoin. So Solana versus Bitcoin, for example, is something that I look a lot at. I actually even look at Atom. I don't want to hold Atom or Cosmos, but I want to hold it if it's strong against Bitcoin. I don't want it. If it's weak against Bitcoin, I want it, because it's been oscillating between a huge range of like 250% for like the past 2 years or something, which means that you can do those swings. So you can, when Atom, for example, is very strong against Bitcoin, you don't want to touch it. But when it's very weak against Bitcoin, maybe then it's worth buying a chunk of Atom, putting it into let's say a trading bot, or just holding it until you see it's strong against Bitcoin. Then you sell it for Bitcoin, and then that's a smart way of kind of looking at things too. So I see that we did get some comments here on what type of investors are in the chat right now. Imre is, where are you? There you are. So Imre is long-term, intuitive, narrow focus, and risk-taking. Cool. I think Golden Goose seems to be, let's see, long-term quant with quite the broad focus and high discipline. That's good. High discipline when it comes to risk is, I usually say, if you're gonna take risk, then being disciplined about it is probably a great idea. I'm risk averse, but if I will take a risk, I will probably do my very best to, like, every time I think I'm gonna do something risky, I always poke Rob, like, Rob, should I really be doing this? And a lot of the time he's like, yeah, go for it.
Dude, so you're not even being risky. Come on, be a true degen.
Yeah, maybe we should start flipping random NFTs. No, it's not something that I really want to do. I'm not much interested in that. And also, Jay made a comment here, said, love what I'm hearing, guys, keep it up. Thank you, Jay. Thank you. We love hearing that you love hearing.
Yes.
That. Yeah, Imre says, put all the money in it. Yeah, all the money. Just put all of it.
All of it.
Precisely. I don't know about you, Rob, but I actually have made a very quick, like, just version of my own portfolio. I mean, and I can show this just how it's structured, but again, people tend to say I am very boring when it comes to building my portfolio and all these things. And yes, I am very boring, because a lot of people in crypto tend to be very high risk taking.
You are very boring.
Yes, I am very boring.
And also, so is your altcoin collection.
My altcoin collection. Yeah, maybe I should get one of those like stamp books and just keep them in there.
Yeah.
Just the code lines instead. I just have my collection of stamps. I'll store my 4 holdings next to my stamp collection. No. Let's see. I'm gonna open this up. So this is what mine looks like when it is. It's not like this exactly right now because of various other stuff that we've done, but it's pretty simple. I call it the 3 legs of the tripod. It's everything is for me, for the most part, divided into 3, like into 3s basically. So for me, in my crypto leg, so in the perfect scenario, when my portfolio is complete, there's 3 legs to it. So you got the crypto leg, then you got the equities leg, and you got the commodities leg, or real estate. I keep that together with the commodities. I usually have just 3 of each thing. So like for stocks, I would have, let's say, Tesla and Google and Apple, and that would be it. Like I hunt alpha, and I've learned this from a lot of different people. So I look for alpha. I don't take much risk. So looking for alpha means looking for the strongest play in that sector, basically, to put it simply, right? And then I tend to I look for alpha, and then I take 2 other plays with that in case things differ, right? So for crypto, I just made my crypto one here. So for crypto, I don't really have the 3 holdings. It's more than that. And for Bitcoin, for me, it's low risk. Ethereum for me is medium. Solana is medium. Polygon is medium. And Crypto.com is actually a coin that I hold, but I don't hold that I don't buy that coin. I use their Crypto.com card a lot. And the cashback for that card is what I just keep on the side. And it just happens to be, my strategy here is hold and utilize the card. And then sometime in the future, maybe I will, be able to live off of the interest on just having the card, basically, which is nuts. But
I'm sure everybody thinks the same thing as well.
Yeah,
all
probably.
5 million users, or however many they have now.
I think 70 million users. It's like an insane amount of users.
Yeah, that went quick.
Yeah. So either way, that's so I have 1 leg. That's the long-term holdings. I got the second leg, which is the active trading. That's medium to long-term, and then I have another leg, which is just swing trading, which is basically part of this. But for the active trading one, it's Solana, Ethereum, Polygon, and they're trading in strategy bots and grid bots. And the allocation of those 20% that I have there is half of it is Solana, and then 1/4 is Ethereum, 1/4 is Polygon. So this is very simply put together. And I do plan to have an Atom ETH bot, actually, because the Atom ETH swings are nuts. I think that's the 250%. The Atom versus BTC, I think, is 600% up and down for 2 years or something in the same range. So I like that. I like Atom for that, but I don't want to keep Atom. And the reason for me why it's high risk for me, it's if I buy a bunch of Atom at the bottom of the range, there's nothing really stopping it from going lower than that. And then my Ethereum will be sold off for Atom, and I don't want that. But at that point, it is what it is, right? And I'll just have to take that. But I do like to have structure it like this, and this is mostly what all my different portfolios is, because this is simple. This is what I mean with narrow focus. It's just 1, 2, 3, 4, 5 total. 4 that I'm actually actively poking around with. So it's not as fun and exciting as yours, Rob, but at least it's simple.
Yeah, well, mine is relatively simple at the moment. I'm not really allocated into much. Simply a lot of waiting around. But it's that's I tend to just have those sort of 4 pots just as a guideline. I'm a lot less strict with my own set of rules than you. I'm happy to have something. If I see a good thing, I'll let it ride. If I don't necessarily want to be too aggressive with keeping hold of things. And I know you like to have regularly start 6 month or to a year bot trading grid bots, and a week later you're talking about turning them off because it's
Yeah.
as perfect as your strategy is, the reality doesn't always play out the same way.
Mhm.
And
And
so I like to remain adaptable.
that's the thing. Being extrovert as I am, I know that I'm a pretty emotional person, right? I care a lot about people. I'm like people tend to, I think it's called being an empath to a degree at least, so that when things start happening, the FOMO for me is real. Like I've done this for quite some time now, but FOMO for me is it's a problem, right? So I'm trying to work myself into kind of ignoring that. But nevertheless, like it's still there, right? And trying to change the way. I mean, I'm 34 years old right now, and almost 35, and my whole life I've spent, thinking in one way. So kind of switching the way that you think like that it's not easy, right? But at least I'm trying.
Try harder.
Oh yeah, maybe I should. No, but yeah, definitely. It's something that I'm working on, and that's my one major issue that I have for myself, where I'm not super happy with where I'm at that with that, But so, by the way, chat, what type of portfolio do you guys have? Obviously, don't say how much you have, but do you have a very diverse portfolio, or do you have just a few names in there, or how do you guys structure yours? It would be fun to know and see kind of what the community kind of has as their. And Golden Goose says, "Go ahead."
As I say, I know I'm still majority cash because these the allocations. We're not fully allocated yet because I'm not unallocated. I've had having these pots there, but right now it's the overall picture is that this is still a risk-off environment, and so having the balls to be able to go in at the bottom is very, very important. Acknowledging that until things really turn around, that every rally is a bear market rally, it's a fool's rally, it's not sustainable until it is. Here is that first example of seeing, is this a reversal? Does this want to put in a higher high and then move higher? And so people can have these long-term portfolio views, but be open to changing what that allocation is as the market changes. You can have a bear market portfolio and then a bull market portfolio, and those can be different portfolios, and you can go look and say, okay, now I'm going to switch into a more bullish portfolio, which doesn't mean balls deep fully allocated, sell your house and everything to buy Bitcoin because it's below 20k. No, that's not what it means. It does mean, okay, maybe this is a period I need to start getting a bit greedier and just shifting my allocation from risk off towards risk on, or just being aware that you don't have to be fixed. You can be a long-term investor and still change your mind, as long as you change your mind with a good, with a sensible end goal. You're not just changing it on a whim because of FOMO. You have a plan, you stick to it. What's the thing? What invalidates the bear market setup? What would make you want to be more bullish? What's the driver that's going to say, okay, no, now I'm going to start allocating more heavily and take more risk?
Yeah, that's the problem that most people do have, because, for example, looking at what's happened in the past couple of months, right? We've had this massive couple of years, like even over a year, but like, we've had a massive downtrend, and people keep thinking, oh, it's going to end, and it never does. And then now we have that scenario again. We had a huge dip after FTX, and then a sideways move, and then we suddenly just had a huge pump out of nowhere, basically. And for someone who is, even if you don't have that, let's call it, if you don't have that mindset or that strategy set up already, that when this and this happens, I'm going to get back in. If you don't have that, then when these things happen, that's when the FOMO really becomes real, right? For most people, and it's not a fun feeling at all for anyone. I don't think anyone is I don't think anyone is immune to the FOMO thing. But when you have a strategy and you have decided that, like, look, this is what I'm going to do when this and this happens, and then I'll just follow my strategy, then that FOMO becomes much more manageable. And
this is what I'm going to do, this is when I'm going to do it, is incredibly important to have. Yeah,
for sure. So I saw, by the way, Imre says, Golden Goose says, Rob's portfolio needs a 65-inch widescreen TV to fit his pie chart on.
that's why I have such a big monitor. I've already taken these steps. I've already fixed this. I have the big monitor.
Have you guys not seen his screen? Huh? No, but yeah, I mean, he's not wrong.
I have relatively few coins at the moment. I will have more, but time and a place. The altcoins, the shitcoin trading casino isn't up and running yet. So until I want to see, for what I have allocated there, I want to see positive price appreciation, but also risk taking and speculation coming back into the market before I want to buy enter the shitcoin casino.
The bottom.
There's no the altcoins can have a bottom way later, as they did in 2019, 2020. Many alts had a lower, their bottom was in 2020, not 2018.
It's kind of fun too. Like every time there's a big dump, for the most part, the whole market says, "Oh, that's the bottom. This is the bottom," and then it goes sideways for a while, and then another boom comes, and everyone's, "Okay, that was the bottom." And I think that happened like 4 or 5 times in the past, since 2021 November. It's like, just wait for the confirmations that you want before you start poking around. Maybe you won't hit the perfect bottom, but let's face it, if you didn't get to buy Bitcoin at 16K, but you now have let's say now finally your all your indicators that you were looking for have turned around, and you buy it at 21K, it's not that much of a difference, especially considering if you bought every time there was a big dump here, your dollar, like that would be a dollar cost averaging, because you would say, oh, that's the bottom, and then you would buy, and then you're like, oh crap, it wasn't. Okay, and then you'll do it again, and then again.
Buy the dip.
Yeah, and then suddenly your cost basis is way higher than 21K, even though you bought some at 16, right? So overall, that as scary as it might feel when you're sitting there and just waiting and you're seeing things go up, it's like it's not the end of the world. And even if the bull market starts and you're like, oh crap, I do have to get in now, well then just get in, right? If you feel like that, then do it. But if you miss out the perfect bottom, it's not a big deal. Come on.
No.
It's like greed is dangerous as well.
And this is you're never going to say that the odds of you both catching the absolute low and catching the absolute top are both as unrealistic as each other. And so don't try. It's a fool's errand to try, because you do not know where the bottom is. So stop trying to pretend you know. You may nail some entries occasionally, but using analysis, you can find bottoms very well. You can find short-term and mid-term bottoms based on a multitude of things. Can you guarantee that you're going to catch them every time? Absolutely not. So it's a fool's errand to try, and that this notion of investing in a certain amount of portion, a certain proportion at particular levels, range lows, areas of confluence that says, okay, this is likely to hold as a big major bottom. then you'll be able to get much better prices overall. Doesn't mean that you're going to be a foolproof investor. Doesn't mean that you aren't going to occasionally bust out and buy things. I remember buying loads of stuff in 2021 that just didn't keep pace with Ethereum. I bought it with Ethereum, and I would have been better off just holding the ETH.
Yeah.
And that's something which is quite needs to be considered, is that your coin may not be the most special. It may not be as special as you think it is. Your project that is going to change the world is still going to go down 98% at the end of it. If you can't keep pace with the likes of Ethereum, of Bitcoin, then you're kind of doing this investing thing wrong, because you're taking extra risk and you're not gaining the extra reward from it. And it's the timing and the discipline and the portfolio management that can give you those supernatural gains beyond what Bitcoin already can provide.
Yeah. This is also why when if you're talking about, let's talk about the swing trading part, right? Where let's say I have Atom trading against ETH, right? When Atom is being strong against ETH, it's great, but it will eventually go down again against ETH, most likely, right? And if you if I have a ETH versus BTC bot that's trading while ETH and Bitcoin are kind of oscillating percentages up and down, I'm making more of both of them, right? So even if Bitcoin goes up against ETH, I get more ETH. I'm like, okay, I'm happy with that. Same thing if I have an ETH versus Solana bot, it does the same thing. If ETH goes up against Solana, I get more Solana, and I'm happy anyway because I want more of both, right?
Yeah.
But the problem is that, let's say I have the Atom versus ETH thing, and ETH explodes against Atom, and Atom just is not as Atom is a pretty good coin overall. It's been around for a long time. It's doing some cool stuff. So it's not the end of the world if some of your ETH sells off against Atom, and you have to hold some Atom for a longer time. But if excuse me, if Atom, if you were to have some coin that's just let's say you managed to find a Bitcoin versus Floki coin or whatever, right? And you're like, oh, I'm gonna start a bot against Bitcoin, and then Bitcoin explodes in value against this shitcoin, and that goes to zero. Well, then all your Bitcoin has been sold into a crappy coin that just doesn't do anything ever again. That's where the risk is. So for me, it's I think I can swing trade between the coins that I want to have in my long-term holdings. So ETH versus Bitcoin, Solana versus ETH, Solana versus Bitcoin, all these things. I'm happy with doing that. But I'm not happy doing, I'm almost not happy doing ETH versus Atom, because I don't believe in Atom in the same regard as I do with something like Polygon or Solana or ETH or whatever. So it's very important, if you're gonna start looking at those type of swing trades, maybe make sure that you actually want both coins, as a long-term holding, and that you have belief in that they will stick around and be a good investment for the long term as well, which is easier said than done. Let's be honest.
Absolutely.
Yeah. So that's that. Oh gosh. Let's see. I need to click around a little bit here. Well, okay, Imre says that his average open on Bitcoin is 36.9k. Let's call it 37k. Well, at this point, for me, if you're looking at Bitcoin as a long-term investment, buying anything under that will just lower your cost basis, right? So
have you been buying since May? It's because say May, that's every single month since May, you'd have been able to get a lower price than that. So have you been reducing your cost basis down over that time?
Yeah, that's one of those things that I tend to try to do if possible. If I know exactly what my cost basis is on my holdings that I currently have, whenever I have the chance to buy to lower that, if you think like that, then the oscillation of price that's going on right now, like it's up and down a few percent every day. Like if it's still under your cost basis, I'm personally kind of happy just buying whenever I can, when I have some cash to deploy. Imri says no, he's not buying anything right now. Okay, well, keep in mind, you're able to lower your cost basis at this point, so maybe it's worth thinking about. Not financial advice, but it's never a bad thing to lower your cost basis, in my opinion. If I was able to, I would. And I am able with one of my coins, so I'm like, okay, trying to find some cash to toss in there. but yes. And by the way, I was almost going to say, hey, let's do some TA, but I just realized tomorrow is Monday, which is TA Monday.
Just that is something, if you want to just pop my screen onto the chart for a second.
Sure.
So here I've just drawn roughly 37k. So here's your average price. So all of these months, if all you did every payday or every time you had one of these drops, if all you did was pick up the range low on these sort of drops, then you can start to see, you don't have to time every bottom and catch every single dip to find these opportune moments to lower your cost basis, to just simply look for these big picture periods. Even something as simple as, say, as one I like to use, or I already have the RSI up, is simply just to look at the RSI, and when that's oversold, you end up with buying opportunities here. If all that happened was that you waited for these oversold opportunities and then started, every time this oversold happens, I'll throw in $100, whatever it is, whatever your budget is. If you have a monthly budget, then you allocate whenever you get one of these big drops, and you can quite quickly and quite effectively lower down your cost basis by buying relatively simple technical indicators.
Yeah, it looks like Imri says his lowest opening is 19.1, which is that's pretty solid, because that's the price is currently above that too. So that probably lowered your cost basis quite a bit then at that point. Well, depending, of course, on how much you were able to put in at the time. And it's 100% right, Rob. Whenever you have the chance, and but it's also a lot about, like you said, according to your own budget. It's not, a lot of people out there, they get into crypto because it's one of those, when you're new to crypto, it's you kind of perceive it as a get rich or make a lot of money really fast type scenario. And it's not necessarily true. It's also something that's equally true as that is lose your money very fast. Especially when someone is new and doesn't have much experience in investing and stuff like that. I'm not saying that's you, Imre. I'm just saying, like, generally speaking, it's the understanding of crypto at this point for the general public is that it's, something that you can get rich on really, really fast. And that's probably not a good way to think about it.
Maybe not, but
what are these green and red lines?
So again, this is simply on the when the RSI is overbought and oversold, that these are the kind of areas that you can have. And we talked about, we talk about in TA in when there are different ways of using TA to invest, and I don't think any of us really would recommend knife catching as such. But if you are somebody who's looking to actually accumulate on a long-term basis, then when you see these little oversold spikes, say all these green and reds are just periods where we went oversold or overbought, and although not perfect, they would have had you buying these relatively high prices in 2021, but they also would have got you into these dips. And given provided some sort of opportunities that said, this is a quite a particular strategy, so it doesn't show up all.
Yeah, I was just about to
But
say
it's
that
like,
you can't see
you know,
that one, but that's supposed to be
no,
there too.
yeah, and but even so, that one is there. That one is there. All of these peaks all gave signs. It's this is what's called a relative oversold, overbought. Actually uses the Bollinger Bands on the RSI,
Okay,
so
cool.
it looks for relatively oversold. So even though here, although you've got a long time in overbought, it
Yeah,
only gave that one as the sell signal,
yeah.
because it then spent a certain time above it. But yeah, this is something that's quite simple to say. If you want to lower your cost basis, buy when this goes green. If you want to, then get out. And for all of the people, even if they bought these, in the 50, 57, 50, whatever, 45, having that opportunity to get out at 43, 47, those were losing trades, right? But it would have saved you a hell of a lot of money over the course of the year if you'd have paid attention to it.
Yeah.
And
It's
that ability. So this is one a good representation of saying, if you can see the market starting to turn, and you get these, these sell signals, sometimes, swallow your pride, accept the loss, and say, this is not a good time to be. This is not good to be invested. I'm going to rebalance my portfolio into a more risk-off
yeah,
scenario, into a more risk-off condition. And so that's that's a way of really sort of being brutally honest with yourself and going, did I make the right decision? And sometimes you can say, nope, I didn't make the right decision. I'm now going to correct that wrong decision. And if you can do that with logic and justification and some certain character traits, perhaps certain personality traits, then will assist in that. Then you can really protect yourself from.
yeah. I agree, and I also think that it's much better to be able, if you're able to, like you said, swallow your pride and say, okay, I made a mistake here. Like, there's no investor in the history of investing that's been 100% correct. It's impossible. Like, that's
No.
just fact. But it's better to be able to say, okay, I made a bad decision here. Be honest with yourself. Get out of the position if you want, and then be able to reassess everything instead of just saying, nope, I am right, and this will change. And then it doesn't. And then when it doesn't, it's you're messed up. It's
Yep.
over. So it's much better to just bite. In Sweden, we say bite the sour apple.
Bite the bullet in the UK.
Yeah, basically.
Yeah.
So it's better to just take the ouchie, put a band-aid on it, and carry on. So
yeah, so just taking it, just flip back onto my screen for a second.
Yeah, sure.
In terms of say talking about narratives and talking about that when your portfolio should be risk on. If we, I don't know how visible all these lines are, but if we've got a very, very well established range on Bitcoin dominance that says, this is by all accounts an accumulation pattern where the market has been the market has been sort of transferring its money. We've had this huge altcoin run, and now slowly we're starting to see a handing back of this dominance, which we've seen these little spikes before. But in a bear market that we've just been through, I would have expected to see Bitcoin dominance rising significantly higher. The market has stayed relatively risk on in terms of whether Bitcoin has not outpaced the broader market for this goes all the way back to May 2021. But from a technical perspective, this is an accumulation pattern. And so should we expect to see Bitcoin dominance rising significantly? Well, at this moment, I don't see a narrative that's going to send this down and essentially set up a new altcoin run. I don't see it. So in terms of portfolio management, well, is this a period of time which is open to risk? Not really. Like, this is not a risky time, a time to be risky in the market. This is a time to be defensive. Which is the defensive crypto? It's Bitcoin. And
Yep.
so, even this chart isn't screaming strength in Bitcoin, but we've got to think what's going to send it down in dominance, as in what's going to make altcoins really start to outpace Bitcoin in this risky environment. Because if we don't see that, then we should start to see, a potential rise up to, up towards this sort of zone here. 60% isn't bearish for the market long term. It's a well needed correction and wipeout of these altcoins. And until we've had, this is another period of going that if you can identify these ranges, investing in altcoins up at this range for a year was a far more profitable move than investing when Bitcoin was already at its lowest point in dominance.
Is this the monthly or weekly? What is this?
Weekly.
It is. Yeah, I thought so. Yeah.
So
it's
this is a long chart, and this chart has basically said to say Bitcoin has not really yet consolidated this whole market. It's not, crypto hasn't made its big risk off move. And in terms of investing for a new cycle, when do you want to invest in altcoins? It's when we have a relative high in Bitcoin dominance, and when the charts say, yeah, Bitcoin dominance has got a little bit overextended, and now that there are a lot of plays in the market that are cheap relative to Bitcoin.
Yeah.
And so I don't think that being in such a volatile asset that you should necessarily have a stable portfolio. I think you should have a very fluid portfolio and be able to adapt, because this is a market that needs a lot of adapting to succeed in.
I think people need to think about as well is that there is a lot of investors out there, crypto investors that, like for me, for example, a portion of my profits that I take, for example, on one of my alts, I roll those into Bitcoin, right? It's the same thing with the swing trading thing. So whenever there is a, towards the end of like a bull run, for example, I don't know. I know that my hopes for myself, or my goal, is to roll some of my altcoin profits into Bitcoin at that point, or more so even. So, it's like Bitcoin for me, like I said, and I think for a lot of other people, Bitcoin is the stronger money than the US dollar. Like at the end, like a stronger, stronger form of money, right? I think a lot of people think like that, which is why I think a lot of people roll their profits into Bitcoin at some point, which is also why Bitcoin is so strong that people view it like, like that in traditional like stock investments, right? People would, when they take profits, they take it into the dollar, and that's that. I don't think they roll a lot of their profits into another stock at the same degree that cryptos would do, that they roll it into Bitcoin.
Part of that is the nature of the degen investor. That is
precisely. So you got to keep that in mind.
Capital allocate.
Yeah, so you got to keep that in mind. But still, like for me, I think that even if I do roll some profits into Bitcoin directly at Bitcoin's top, it's still, comparatively to the altcoins that have gone up, it's still a good trade, right?
Yeah.
But rolling it into the dollar and then buying the Bitcoin later is probably even smarter, but that's also much easier said than done, right?
So, yes, of course.
But I think that's a mindset of a lot of people anyway, the whole rolling it into Bitcoin type of profit taking. I might be wrong, but just a thought.
Well, no, this is something that we're going to see more and more and more of as the market matures. And so...
Yeah, and when Bitcoin becomes more stable too, or less volatile.
Which it's on course to do. This has been a significantly less volatile market than 4 years ago, than 8 years ago. You know,
Mhm.
it's not that it is slowing down. It's becoming more up. It's everybody kind of thought 2021 was the wave of institutional investment, and it's like, no, it's the start of institutional investment. We haven't
Yeah.
yet had the normalization of investment.
Yeah.
We don't have pension funds, hedge funds, investment firms, family offices really
Yeah.
en masse going in and putting 5 and 10% of their portfolio into this.
Yeah.
That's down the line. And so, say part of that investment thesis, your investment thesis should include either holding during 50 or 60% drawdowns, or being a trader and accepting that actually the odds are against you, and you are more likely to make lower gains by trading than you are simply holding. But also not being, you know, especially if you're a retail investor, is having the awareness of when, if you've made some life-changing money, go change your life with it.
Yeah.
Don't go and sit around waiting on a bigger dream. Don't get caught up in the greed. Don't get caught up in the and that's, you know, goes full circle to what we were talking about before. The FOMO is hard to ignore.
Yeah.
It's starting to listen to, and time is a great, you know, time teaches us, you know, how to ignore that patience, how to be patient and ignore that fear of missing out.
Yeah.
That how many people are currently saying we'll never see Bitcoin below 20k again? Like, you know, you started to hear it a little bit. Oh yeah, no, it's going to push higher, push higher, push higher. It may well push higher. Doesn't mean it can't roll back 50% again.
Yeah.
So
I mean,
50% or more pullbacks should be priced in to your investment into this asset class, as in
Yeah.
only buy potentially after it's pulled back 50%. If you just did that in this market, you'd slay it.
Yeah, I wanna touch on what you said here. You said, you know, if you made life-changing money, then go change your life with it, and that's it can't be more true, because, like, why are you investing in Bitcoin and crypto? Are you investing in Bitcoin crypto because you just want to have Bitcoin sitting there? Probably not. Your goal when you started was probably something along the lines of, I'm gonna do this to create some wealth so I can, you know, get a nicer house, or get a house or an apartment, maybe upgrade my car or whatever. You know, it's like, if you, this is why my portfolio is structured 60% holding, 20% trading, 20% swing trading. So when the 20% that is my trading portfolio, that's the 20% of my total value on the portfolio, right?
Yeah.
So that means that when I do take profits, because I do, I'd roll some of it into Bitcoin, and then I roll some of it into a stable coin to prepare for the next run. But at the end of the day, the goal is to, you know, I'll profit taking, in a sense, doesn't have to be into the dollar. It can be into the dollar and then roll that into buying real estate or something, as a more, that maybe you want to get into the real estate business where you can buy a bunch of commercial real estate or industry real estate that you can rent out and just earn a passive income. That's great. Maybe that's a safer play than holding a bunch of Bitcoin or selling all your Bitcoin. Maybe you can borrow against your Bitcoin to do that in the future. Who knows? Like, I tend to say that rolling it into something that is a more safer play, I think it's kind of the end game thinking that I have, at least, that, yeah, I can make some risk taking here, I can do this and that. At the end of the day, I want to pull that out and I want to put it into some kind of real estate that I can rent out to have a passive income. That will simplify the rest of my life. And it's a very safe thing, because you can always find someone who wants to rent an apartment. You can always find a business that wants to rent your...
For now.
Well, for now, yes.
Historically, forward, though, is that the case? And so
historically, it's a much safer and much more boring, thing. So, but yes, let's see. I need to respond here.
you're responding.
Yes, I'm responding to your message. So,
Ah.
but yeah, I think I agree with you too. We can probably start rounding this off right now, because we have been live for about an hour, and I feel like we've kind of touched on everything that we were planning on talking about, and even more.
As
the
always.
whole idea, yeah, the whole idea here today was to kind of just talk about portfolio structure and portfolio management, and trying to help, kind of trying to help you all think about what type of person you are, so that you can find the best way for yourself to do things in terms of investing and managing your portfolio. Because if you don't really know, like, if you know what you're comfortable with, then it's much easier to make a portfolio structure that works for you, that you will feel better, less FOMO-y about. So yeah, keep that in mind, and go back in the video later on when it's uploaded completely, and then take some screenshots if you want. You have my blessing.
Watch it all again first, just to help the algorithm.
Yeah,
more than 100% view time. Perfect.
Yeah, so whenever you go to bed tonight, put repeat on this video and just let it run on your phone throughout the night, and on your computer on another account. And no. But yes, all the likes and all the subs and all these things, they help. I want to say too that for everyone who's watching during this live, and for everyone who's watching this after the live is over, join our Discord, because we tend to sit there most of the day talking about stuff, discussing things, helping each other out. That's kind of what the whole point of the Discord is. We want to have a network where you can teach others. We can learn from you. You can learn from us. There's always something. Perspectives are great. So make sure you join the Discord. The link is in the description down below. And yeah, I think we're going to jump in there right after we end this stream. So if you want to hang out for a bit and talk about stuff, maybe if you have any cool ideas, let us know. It would be great. So
I expect at least 6 people to be in the Discord.
Yeah, there are 6 people. There are 6 people watching right now.
Yeah.
So
6 people in the Discord.
Yes, exactly. If you don't come, I'm gonna be sad. Yeah. Super sad. All right, so everybody, we're gonna end it here. So thanks for watching, and remember, like, subscribe, and hit the notification bell thingy, and we'll see you in the next one. So tomorrow, by the way, is TA Monday. We're gonna do some TA on Bitcoin again. It's gone sort of the way that we were looking at, and it's all good and dandy. So we'll see you then.
See you then.
All good and dandy. All right, cheers, everybody. Bye.